This is the 2025 FOREX Trading Empire Mentorship Program, Lecture 8. The topic for this lecture is Power of 3. So on the previous lecture, we have been talking about the elementary trade setup, and we have discussed about every reference point, which I find is more important and necessary for you guys to understand before going further into the lectures. So now we're going to go into the Power of 3, understanding the Power of 3. The Power of 3, understanding that in every price range, there's a three-phase price pattern. That means in every time capsule in the chart, either you're using the 5-minute time frame, 15-minute time frame, even the 1-minute time frame, 4-hour time frame, daily time frame, or the weekly time frame, or the monthly time frame, there is a three-phase price normally go through before delivering price during that time period. And those three phases are the accumulation, the manipulation, and the distributional phase. So those three phases will occur for price to deliver a price during a time range. So during that time range, from the opening price to the closing price, you are anticipating price to go through these three phases. In a bull direction where you are anticipating higher prices, from the open, low, high, and close, you are anticipating the three phase, which the accumulation is when the smart money is accumulating order. The manipulation is where the smart money is manipulating traders to the wrong direction. And the distribution is where they are distributing price to the intended direction. So in a bull direction where they are anticipating higher prices or where they are looking to push price higher, the manipulation will be below the opening price, which is going to be below the manipulation. Going below the manipulation is enticing traders to sell so that they can manipulate price higher. So if you're anticipating higher prices and looking at this three phase, putting this three phase in mind of the accumulation, the manipulation, and the distribution, same price creating the low below the opening price, then you're anticipating price to create the high higher than the opening price, just like a basic candle where if price were to close above the opening price is a bull candle. The same thing goes to a bearish direction. In a bearish direction, from the opening price, we are anticipating open, high, low, close. We're anticipating this trade phase to happen between these phases. From the opening price, going above the opening price is the manipulation. From the opening price is the accumulation. Above the opening price is the manipulation, and below the opening price is the distribution, because they are trying to drag the price lower, trying to create a bearish market or a bearish trend. So the three phase, you need to understand the three phase, the accumulation, the manipulation, and the distributional phase to go further into these lectures. Now, the power of three, we're going to talk about the power of three individually from the power of three in a bull condition, the power of three in a bear condition, because that I think is the two most important trend, and this is the only trend. So understand the power of three in a bull condition and understand the power of three in a bear condition is something you need to put in mind, is what I'm going to be explaining in this lecture. And the last is the importance of developing an anticipatorial skills. Now, learning how to anticipate price, how to anticipate candles is going to be one of the major skills you'll be needing in this lecture. The reason is that if you understand the power of three, and you know that if price were to create an up close candle, it's going to go through the three phase, the accumulation, the manipulation, and the distribution. Now, knowing when to look for a bull condition is learning the skill to anticipate. To anticipate if the candle is going to be an up close candle or is going to be a down close candle. Then the power of three is the phase you put in mind while applying the proper elements to a trade setup using the right reference point. You can easily understand the power of three, and you can easily take advantage of your anticipation. What you anticipated, if price were to trade to that direction, it will be easy for you to take advantage of it because you understand the power of three and you understand the elementary trade setup. So from this lecture, you should start to learn the skills of learning how to anticipate the next candle, the next weekly candle, the next daily candle, the next 4-hour candle, the next 5-minute candle, whatever time frame you choose to use. I'm going to talk more on the importance of developing anticipatory skills on further lectures, but we're going to touch a little bit about it in this lecture. Now, power of 3 in the bull condition. In the power of 3 in the bull condition, from the opening price, remember in the up close candle, which is the bull candle, from the opening price is below, the closing price is above. From the opening price to the closing price, from the opening price is the accumulation phase. Below the opening price is the manipulation phase, which in a bull candle, you're going to see it as a candle's wick. The candle wick below the opening price is the manipulation phase, where the manipulated traders enticing them to sell where they are looking for higher prices. So the manipulation is the wick below the accumulation, which is mostly the best place to look for your entry or to look for confirmation to your trade setup. After the manipulation phase below the opening price, as soon as price trades above the opening price, trading higher is a distributional phase where price is trading to a premium liquidity, trading to a premium reference point based off the time frame, which we'll be explaining more in this lecture. Now, understanding that from the open, low, high, and close, from the opening price is the accumulation phase, below the opening price is the manipulation phase, above the opening price is the distributional phase in a power of 3 in a bull condition. Now, power of 3 in a bull condition, seeing it in a chart form is way easier. Now, look at the opening price. Here's the opening price. Price traded below the opening price. This is the manipulation phase. You can see I use a little rectangle to mark it red, trying to show you guys that below the opening price is the manipulation phase, then above the opening price is the distribution. Same price going below the opening price is enticing sellers to go to trade the wrong direction to accumulate liquidity. It's still part of the accumulational phase, but it's being called the manipulation phase because they are trading at the wrong direction to manipulate traders. Manipulating traders below the opening price, then driving price to the intended direction above the opening price, trading higher. And you can spot this in any time frame you plan on using, either the 15-minute, 5-minute, 4-hour, daily time frame, weekly time frame. And you can easily apply this to a bias. Understanding the power of 3 is as easy as trading a bias. We talked about premium and discount. When you apply premium and discount and the power of 3, it makes it easier for you to understand bias. All these lectures is to later come up to a situation where you can easily spot out the bias. These are little pieces leading to a trade setup, or these are little pieces leading to understanding bias and understanding when to take advantage. Which in most cases, you'll be looking for price to trade to a discount liquidity below the opening price. A discount liquidity below the opening price, then you're looking for a price reaction away from that discount liquidity. Because below the opening price will be a discount price. You'll be looking at the opening price as an equilibrium price. The opening price of every candlestick is an equilibrium price, because price is not in the premium price or in a discount price within that time period. So if it's in a daily time frame and price is still at the opening price, price is still at the equilibrium price. Below the equilibrium price is the discount, and above the equilibrium price is the premium. Price trading to a discount is seeking discount liquidities, and discount liquidity will be a fair value gap, a discount fair value gap, a discount sell side liquidity. Price will gravitate to run out those liquidity because smart money will look to buy at a discount. So they are bringing price to a discount. They are anticipating higher prices, so they'll buy at a discount and sell to a premium during the distributional phase. Now you see how applying the idea of the premium and discount to the power of 3 makes it more easier to understand. So looking at the opening price as your equilibrium price, below the opening price as your discount price, and above the opening price as your premium price. Now, let's go to the chart as promised. I promised that I'll make this lectures more practical. Go to the chart, we spot it out. So let's go to the Euro USD chart. This is the recent price action. We talked about it in the Disco live classes on how I was looking for higher prices on the dollar index. So let's go to the dollar index and spot out individual days where there's a power of 3 from a daily time frame. Then I will show you that in every time frame there is a power of 3. So let's move to the chart. Now we're on the dollar index, the daily time frame of the dollar index. Now we're not going to be talking about bias completely. I'm just going to be pointing out the up close candle, and we're going to look at the up close candle from a lower time frame perspective to learn how to spot out the power of 3, because it's going to be one of the best way for you to practice on how to spot out power of 3. So we're going to go through this last previous 3 up close candle, 1, 2, and 3. So let's put a horizontal line on the individual candle so that when we go to lower time frame, we can easily spot out the candles. So next, when I'm looking at the daily time frame, if I want to identify the power of 3 to look for price to trade to, and you might want to note this out because this is about using multiple time frame. So when I'm looking at a daily power of 3 where I'm anticipating, let me just say this example, I'm anticipating higher prices. The time frame I look to see the power of 3 where price is trading to a discount, says I'm looking for higher prices, is mostly the 1 hour time frame. I use between the range of the 1 hour to the 15 minutes. I stay in between those time frames. While sometimes I just go through the 4 hour for a while just to look at more reference point to see if it's aligned with my bias. But in this example, I'm going to look at the 1 hour time frame to spot out the power of 3. So let's go to the 1 hour time frame. Now on the 1 hour time frame, we're going to go through the first candle. Now here's the first candle. This is the opening price of the candle, and here's the closing price of the candle. Remember, I talked about the accumulation from the opening price. Here's the accumulation. You can see how price accumulated. Let's set this at orange. Price accumulated, traded lower, took out both side liquidity before trading lower. Here is the manipulation. And where is price going? Price is going for this sell side liquidity. This is the discount price going below the opening price. Going below the opening price is going for a discount sell side liquidity. A discount sell side liquidity, price is taking out the discount sell side liquidity because the smart money are now looking to buy. Price traded to a discount after running the sell side liquidity, creating the manipulation phase, which will highlight it as, let's just set it below the accumulation, below the opening price as red. This is the manipulation phase going for the sell side liquidity. Now, after the manipulation phase, price running out the sell side liquidity, this is between a daily delivery. This is a daily time frame from the opening price to the closing price. So I can remind you guys then, this is a distribution creating the high. So open, low, high, and closing price. The distributional phase, price traded higher, distributed to this high, which would set it as green. And you can see how price traded to the closing price. Price almost went back to the equilibrium price after distributing to the upside, running out buy side liquidity, premium liquidity. Most cases price do some sort of retracement back to the mid-range. That's when you see a doji candle or a low body candle. This is an example of a low body candle, but you can still spot out the power of 3 very easily. Accumulation, manipulation below the opening price, going for sell side liquidity, then a distribution. Now, if you were to learn the skills of anticipating, or the skills to anticipate price, you'll be anticipating price to trade to the upside. You're anticipating an up close candle. If you're anticipating an up close candle from the opening price haven't traded to any major liquidity so far. Price only opened, did a few consolidation, traded higher, created an equal high from this high to this high. After creating an equal high, I think it swept the buy side liquidity a little, then price traded lower. Now, seeing the price is trading lower, going for this sell side liquidity, you know the price is doing the manipulation. Then on lower time frame, you look for a shift in market structure leading to higher prices for price to distribute to the upside, which is mostly going to be the 5 minutes or the 15 minutes. You can range between those time frames. Now let's go to the next day. Now the next day, still the same concept. Here's the opening price. So let me mark out the opening price now. Here's the opening price. Set it as blue as the equilibrium price. Here's the equilibrium price. Below the equilibrium price, which is a discount, we are anticipating higher prices. Price traded below the equilibrium price as the manipulation phase. Where is price manipulating to? Now we can take this off. Let's spot out this to a discount fair value gap. You can see the fair value gap. Price traded to a discount fair value gap, doing the manipulation, enticing traders to sell. After enticing traders to sell, to fill out the fair value gap, to go for this doji order block, because here's another block. But seeing this doji candle, in most cases, this is the candle price with reference to. I'll talk more on this when we get to live trading sections. Price traded to the fair value gap, fill the fair value gap, price is at a discount. We're anticipating higher prices. This is the manipulational phase. Price is manipulating. After the manipulation, price traded above the opening price, traded to a distributional phase. So if I'm to box it, this will be the manipulation. At your early stage, try to identify it like this so that when you're going back to practice on it, it will be more easier. And here's the distributional phase. Price distributed higher. Now, open, low, high, and here's the closing price. A complete power of 3. Accumulation at the opening price, distribution below the opening price. Accumulation at the opening price, distribution below, manipulation below the opening price, distribution above the opening price. So looking at it as an equilibrium price, price traded to a discount, you buy at a discount, you sell to a premium. And I've been talking about this idea for a while, that smart money look to buy at a discount and sell at a premium. And here's a great example. Below the opening price as the equilibrium, because in every day, the opening price is the equilibrium, or in any time frame, the opening price is the equilibrium. The opening price is the equilibrium of each individual candle, even if it's the 1 hour candle. Price traded higher above the opening price, close. Now, you can practice this individually, which I've explained. You need to make it more practical. Do this individually. Go to your charts, learn how to spot out areas like this. So here's the last candle. Let me put it at the closing price. Here's the closing price of the candle. Now the last candle, opening price. Trade below the opening price is the manipulational phase. Price trading to a discount. Price traded to a discount. You can see a discount fair value gap here. Price manipulated to the fair value gap, traded higher, which is a classic power of 3. Accumulation, manipulation, and distribution. As simple as that. On any time frame, we spot out price action like this. Although there might be some times where price is opening from the opening price doesn't trade lower than the opening price. Sometimes it's due to high impulsive price action or run on liquidity. But it's better to understand what have the higher probability of playing out than the low probability scenario. So when it comes to price profile, individual candle profile, you are anticipating a power of 3 on every individual candle, even if the 1 minute, 15 minutes, 5 minutes, 4-hour daily candle. You are looking for a market profile of an accumulation, manipulation, and a distribution. Now, looking at it from an individual candle, let's look at a 1-hour candle. So we can still look at the 1-hour candle. So you guys that it happens on every time frame. So here is 2 1-hour candle. Currently, we have 3 minutes before this candle close, but we can still use that as an example. Let's just mark out both candle. We use the 5-minute time frame to spot out the phases. So opening price, traded lower, manipulation, closed above. Here's the closing price. Kind of like close to the opening price, just a few candles from the opening price. The same goes to the next candle, which is the current candle. Below the candle, manipulation to this other block, respected the other block, distributed, retraced back to this other block, respected, trading now price at its closing price, which if I'm to place a line at the opening price to be like this, below the opening price, discount, traded to a discount order block, respected the discount order block. Let's mark out the discount order block. Here's a discount order block. Traded to a discount order block, respected the discount order block, traded higher, went above the opening price, and price at the premium. Went for this buy side liquidity, retracement back to this order block again, went below the equilibrium price to a discount order block. After trading to the discount order block, that's where price is getting this momentum of trading higher. Now, price will close in a few minutes, which from the closing price it will be an open, low, high, close. Now, power of 3 in a bearish condition. Power of 3 in a bearish condition is the opposite of power of 3 in a bull condition. Now, we know in a bearish candle, the opening price is above the candle and the closing price is below the opening price. So below the opening price, that's what forms a bearish candle. So from the opening price to the closing price, we have an open, high, low, close. So an open, low, high, close leads to a bearish candle. From the opening price is the accumulation phase. Above the opening price is the manipulational phase, and below the opening price is the distributional phase. Now, in this scenario, the smart one is looking to buy at a premium and sell at a discount. So if they're looking to buy at a premium above the opening price is the equilibrium price, above the opening price is the manipulation, and below the opening price is the distribution. So above the opening price, premium market, below the opening price, a discount market. Now, looking at it from a chart perspective, from an opening price, premium market, below the opening price, distribution. You mostly identify the high impulsive move once price crossed the opening price. That's what you're seeing, an impulsive move trading lower. Still the same to the power of 3 we discussed in a bull condition. Price will seek out premium liquidity. After price trades to a premium liquidity, price will trade lower and trade to the full distribution. So understanding the 3 phase in every time capsule or in any time frame: accumulation, manipulation, and distribution. Using the idea of premium and discount, above the opening price is the premium, below the opening price is the discount. Now let's look at a chart example from Hero USD. Daily time frame of Hero USD. So we're going to look at the last recent 3 down close candle at the daily time frame. setting out an horizontal line so that we can easily spot it out on lower time frame. Now let's say we're anticipating lower, or we're anticipating down close candle. Now we're looking at it from a power of three perspective, applying the premium, the power of three, and the anticipational skills on how to anticipate price. Let's look at the 1 hour time frame. Now the first candle, you can see the manipulation phase, which is going to be at the opening price. At the opening price, the manipulation phase, below the opening price is trading to a premium. We are anticipating lower prices. Premium price, manipulation. Trade to manipulation, which will be setting it at red. Manipulated, took out buy side liquidity. Price trade to this buy side liquidity. Run out the buy side liquidity with the manipulation phase. After the run on the buy side liquidity, price traded below the opening price. And let's mark out the opening price. So in every daily, if you are a weekly trader, day trader, it depends on whatever time frame you use for your bias to identify, to anticipate where is the candle trading to. Get used in marking out the opening price, knowing the opening price, so that you can easily gauge it at, to know the equilibrium price. So here's the opening price, above the opening price, running out buy side liquidity, running out premium liquidity, trading below the opening price, trading to a discount. Now let's look at the next day. The next day, the same, accumulation, manipulation to this fair value gap. Price manipulated to this fair value gap. You can see the fair value gap. After the manipulation to the fair value gap, price traded lower, going below the opening price. Traded below the opening price from the accumulation to the distribution, manipulation, and to the distribution. So now let's talk about where's the easy part to trade on. Now, going from the opening price, if you're looking for lower prices, you would like to see price trade to an opposite side liquidity, which is going to be above the opening price, trading to a premium liquidity if you're anticipating lower prices. After price trade to that premium liquidity, I think that's the best time for you to look for your entry, because as soon as price trades to this fair value gap, mid region of the fair value gap, that's where you can look for your entry, looking for a shifting market structure to look for lower prices, trading lower. You can practice on it, go lower than this, and do more study case on the power of three and looking at price after the manipulation. After price manipulates, running to this fair value gap, premium fair value gap, and running out this buy side liquidity. You want to look at how price did the shift in market structure, trading lower. That is a shift or a change in market structure. We can identify from this time frame to go to lower time frame. Now the last candle, which you can see manipulation, price manipulated. There are some example where from the opening price will just manipulate to a liquidity, to a reference point immediately, then distribute. It's mostly when there's a trend continuation from a higher time frame, higher than the current time frame you are using. If there's a trend continuation, if price in a trend continuational phase, which I'll talk about it when we get to how to anticipate individual candle. There are some individual candle you're trying to anticipate, which is going to be a trend continuation, and there's going to be some times you'll be anticipating reversal candles. So we're anticipating a trend continuation candle because we are looking for lower price or price to run out this equal low. We talked about it in the live class in Discord community. Looking for price to run out this sell side liquidity, which means we're looking for a trend continuation. From the opening price open, traded to the fair value gap, immediately price distributed lower. So when you see a phase like this, you understand that price is in a continuational phase. That's why there's a quick manipulation before it completes distribution lower. And this is a good time for you to accumulate your position if you are a swing trader holding long position, trading lower. Now that you have understand the power of three, accumulation, you can see distribution lower. You go do your own practice individually, learn how to spot out the power of three in any time frame. So let's do a little scroll through from the 15-minute time frame. Let's go to the 15-minute time frame. Let's do a little play. So 15-minute time frame, 1, 2, and 3. I'm looking at the last recent 15-minute time frame. We'll look at it from a 1-minute perspective. I talk about in every price range there's a power of 3. So the first candle opened, trade below the opening price, took out sell side liquidity, took out discount liquidity. After the run on the discount liquidity, you can see how price trade above the opening price and close. Trading above the opening price, price closed above the opening price. So the next candle, open, 1 minute, traded higher, left out a fair value gap at the opening range, which means this is another block. Because this is the last down close candle that led to this change in delivery. Here's the other block, a discount order block from the opening price. Price traded lower to the opening price to this order block, filled to the mid range of the order block, respected it, distribute higher. So open, low, high, and close. The same thing goes to this. So you can easily pick up a 15-minute time frame and look at it at that time perspective and learn how to identify the power of three so that you can have more practice, because I can tell you that in trading, practice do make you better. When you practice, spend more time on the charts on individual days, it helps you to understand and make it easy for you to spot out the power of three or spot out premium or discount arrays or whatever you're having difficulty to spot out on the chart, because as soon as you learn how to recognize it much easier, you can easily trade off those ideas. Now, the importance of understanding learning how to develop the skills to anticipate an individual candle is going to be helping you in bias. So it's very important for you to learn how to anticipate an individual candle, which I'll be doing a full lecture on it. And the lecture is going to take a whole lot of time to do a lecture like that because it's going to be on a live market. We're going to be anticipating the 5-minute candle, 1-minute candle. It depends on whatever candlestick we'll later decide on the lecture. But the importance of understanding how to anticipate an individual candle will really help you in your bias. So going further from this lecture, try to do it on a daily basis, learning how to anticipate individual candles, because after practicing more for you to learn how to anticipate, you can apply that idea on a weekly, daily, 4-hour time frame, and those will help you in understanding bias. That's all for this lecture. That's it for this lecture. See you guys in the next lecture.